in the face of what I see as society being between the rock higher nominal interest rates and a liquidity crisis, that the market share of gold and precious metals related assets is less than 1/2 of 1%, which is to say 1/2 of 1% of all the savings and investment assets in the United States are in precious metals or precious metals oriented assets. If precious metals reverted to mean, demand for them would quadruple. And that's precisely what I think is going to happen.
Rick Rule, the founder of Rule Investment Media, is raising concerns about a possible liquidity crisis, acknowledging its potential impact. The last instance of the financial system encountering low liquidity was in 2019, when bank reserves dropped to approximately $1.5 trillion, necessitating intervention by the Fed. Since then, executives suggest that the threshold has likely risen, partly due to increased economic activity and stricter regulations. Rule observes the escalating government debt, emphasizing that the on-balance liabilities of the U.S. government now exceed 100% of GDP, significantly constraining the government's capacity to spend its way out of economic challenges. With the U.S. government debt at $33.2 trillion, the country constitutes over a third of the world's total debt. As of 2023, the U.S. national debt is $32 trillion, equivalent to 123% of the country's GDP. Comparatively, 2 decades ago, the U.S. debt-to-GDP ratio was less than half of its current value, although it remains below the G7 average of 128%. A high debt-to-GDP ratio, especially if excessive, may signal difficulties in meeting financial obligations, potentially leading to economic instability. Despite a 5.2% increase in real gross domestic product, GDP, in the third quarter of 2023, primarily driven by consumer spending and inventory investment, diminished financial flexibility presents a substantial challenge in handling future economic crises. This reduced flexibility could make navigating tough times more challenging compared to the conditions 2008. Rick advocates for the inclusion of gold and precious metals-related investments in portfolios. Gold, which continues to allure investors and economists after reaching record highs, is often viewed as a haven. Its recent unprecedented value surge has led Rule to consider owning gold not just for incremental price movements, but as a safeguard against potential substantial increases, possibly reaching $6,000 per ounce. He underscores that these assets serve as an insurance policy, where a modest allocation, around 10% of one's net worth, could mitigate or potentially eliminate losses experienced in other asset classes during economic turbulence. We'll share clips from Rick Rule's interview with Mike Maloney, but before that, if you'd like more videos, please subscribe and turn on the notification bell for updates. Thank you and enjoy the video.
What I'd prefer that your listeners thought or thought about was, is there a probability or a strong possibility that that would occur? And if there's a probability or strong possibility, is your own personal balance sheet, your portfolio, does it take that into account?
Right. Is it
How
resilient
did you
enough?
feel coming into 2008? Did you have sufficient liquidity so that when a liquidity crisis hit, you had the ability to take advantage of the situation, or were you taken advantage of by the situation? People need to look at their own portfolios. We've discussed liquidity before. People say, well, I don't want to have savings because, as you say, the interest that I earn on my savings doesn't match inflation. My suggestion to those people is that the purchasing power decline that they suffer with interest should be considered an option payment on having the liquidity to take advantage of a 2008 circumstance. Yes. Rather than being taken advantage of. Something that people need to keep in mind, and I'm not one who says necessarily that we are going to have a liquidity crisis anytime soon. I actually personally believe there's a probability of it, but as you and I have talked about before, Doug Casey and I between us have called 17 of the last 3 declines, so I'm always concerned. I'm a credit guy, you know. But think about this, Mike, and I hope your audience thinks about this. When we went into 2008, government debt, on balance sheet, not off balance sheet, on balance sheet liabilities of the U.S. government were about 25% of GDP. In other words, the government still had the ammo to push on the string. Recourse liabilities of the government now, full recourse, which is to say on balance sheet liabilities of the U.S. government, now exceed 100% of GDP.
Mhm.
So the necessary ability of the government to print and spend their way out of a circumstance is materially diminished. I'm not trying to say that the confidence in the US economy doesn't exist to the extent that they wouldn't be able to do it, but it would be much, much, much more challenging from my point of view, just because of simple arithmetic. Debt as a percentage of GDP has quadrupled, which means that the financial flexibility has probably declined concomitantly. Now, you as a commentator and your audience, I suspect, as a consequence of them following you as a commentator, necessarily needs to include gold and precious metals related investments in the conversation. I am fond of saying I don't own gold because I think it might go from 2,000 to 2,200. I own gold because it might go to 6,000 or 7,000 or 8,000.
Then a factor of 4.
If you assume that prices are set on the margin between supply and demand, not aggregate supply and aggregate demand, what you say is true. But again, I don't need that to make my argument to your listeners. I just need to say that most Americans need to own more of it rather than less. And the consequence of that is that a price target is higher, not lower. I don't think that investors, unless they're extremely knowledgeable and extremely hardworking, should be over-invested in precious metals. Because the truth is, it's an insurance policy where a small premium buys a fairly large payoff. A circumstance where 10% of your net worth is in precious metals and precious metals related assets. If past is prologue with regards to the price performance of these assets during tough economic times, the performance of this 10% of your portfolio in precious metals will offset, if not eliminate, the deterioration that you would see in a whole host of other asset classes. And that's the argument that I'm trying to make here. If you consider physical gold itself as an insurance class and other precious metals related assets like high quality gold stocks as investments, the performance that you get out of this sector means that a fairly small proportion of your portfolio fulfills the insurance function that gold has filled for investors for 2,000 years. And that's what I'm advocating, Mike.
The U.S. central bank is anticipated to maintain rates of 5.25% to 5.50%. This upcoming meeting would mark the third consecutive occasion where the Fed has opted to keep rates steady after a rapid series of increases that commenced in March 2022. At the outset of the Fed's rate hikes last year, annual inflation stood at approximately 8%. By June, it had peaked at 9.1%. However, in November, inflation had subsided to a more moderate 3.1%. The most recent rate hike by the Fed occurred at the end of July. There's a growing consensus among experts and investors that the Fed might have concluded its interest rate increases for the foreseeable future. Rick observes a trend where inflation disproportionately favors the wealthy. Over 4 decades marked by consistently low interest rates, individuals like himself, equipped with financial means and expertise, have benefited from this environment. Having access to credit and the know-how to utilize it, he could invest in tangible assets, particularly real estate, capitalizing on reduced capital costs. Rick cautions about potential market repercussions and a decline in market confidence should the Federal Reserve make a significant policy shift. While he specializes more in analyzing credit than interest rates, he finds this intricate situation captivating, advising listeners to consider these factors when making financial decisions. Let's get back to the interview.
When the voters think about inflation, if they do think about inflation, first of all, they think about the CPI, which, as you suggest, is a lie. The second thing about inflation is that, oddly, it benefits the rich more than anybody else. A period of low interest rates, like we went through, lower interest rates, which we went through for 40 years, and high, at least replacement cost inflation, benefited old, fat, bald, rich guys like me. I had access to credit. I had the education to understand how to apply the credit. I bought real assets, and my cost of capital was below what it would be in a normal set of circumstances. At the same time as the replacement value of the assets I bought, things like almond groves and apartment buildings increase. Ironically, these government programs, if you are clever enough to dodge them, worked out very well, but not in the way that either the politicians, I think, or the voters intended them. It's interesting to see now that Jim Grant suggests the conundrum that the natural interest rate, which is to say the interest rate which would attract private capital relative to the deterioration of the purchasing power of the dollar, is quite high. And there is some threat of a failed auction, treasury auction, which means that from his point of view, the probability is that the nominal or false interest rate stays higher for longer than other people believe. He also says that if that doesn't occur, if there is a Fed pivot, that it will have a profound impact on faith in the market and perhaps an impact on market liquidity. I'm not saying this is going to happen. Jim Grant is better at stuff than me. I'm just a credit analyst, not an interest rate analyst. But it really, truly is an interesting conundrum. And I think it's something that all of your listeners need to take into account with their own actions, which is...
Looking forward, rising government debt surpassing the yearly economy raises concerns. Recent growth leans on consumer spending, but this fragility might complicate future downturns. Gold is considered a safe haven asset during market volatility, historically less tied to stocks and bonds. How might rising government debt impacting economic fragility shape our reliance on safe haven assets like gold in the face of potential downturns? Share your observations in the comments section below. Also, ensure you like this video, subscribe to the channel, and turn on post notifications for more videos like this. Thanks for watching.